Welcome to January 2026, the year that many of us have been waiting for. Let's just say I'm cautiously optimistic, but not enough to stop side-eyeing the Fed. Here's the big news that just dropped. Mortgage rates have dipped into the fives, around 5.99 on the 30-year average, following a major announcement from Washington. Recent reports show that this drop coinciding with a plan announced by President Trump to direct $200 billion in purchases of mortgage-backed securities aimed to push borrowing costs lower and make homeownership more affordable. That's a really significant development for the housing market. Rates under 6% were something buyers haven't seen consistently in years, and that shift alone has drawn new interest back into the market. So let's unpack how that fits with the other trends we're tracking as we kick off 2026. Affordability is already improving. Interest rates gravitating towards the fives combined with modest income growth is giving buyers a little more breathing room that we've had in a while. And sellers are remaining flexible on price and concessions in many areas, and that combination is helping get more deals done. People are also moving more often now, proving that the old golden handcuff idea that nobody wants to sell their 2 and 3% mortgage, it's not entirely holding up. Life still happens, and now that rates are trending lower, people are more willing to take the next step. Inventory and local conditions still matter. We ended in the Valley in 2025 with fewer active listings than we had in the summer. Roughly 23,000 off-market homes after excluding under contract properties. That's down from over 26,000 in June. Less competition from sellers can support pricing even as buyer interest grows. So what's driving the broader market right now? There are a few major forces to watch. Inflation data, it's continuing to cool, especially in the housing and rent, and that's a big factor in the overall cost of living influences on the consumer price index. Job data has softened slightly this winter, and that actually ironically helps mortgage rates because investors tend to move towards bonds and mortgage-backed securities during times of economic uncertainty. And while the Federal Reserve hasn't made any big rate changes, a pivot or pause mid-year, possibly with new leadership, remains in the conversation. My reminder there is simple. Predicting the Fed comes with more disclaimers than a pharmaceutical ad. So now layer on top of that today's news about the planned $200 billion in MBS purchases, something markets reacted to immediately with both mortgage rates dipping and mortgage-related stocks jumping. Experts do caution, though, that a one-time boost in mortgage bond demand doesn't guarantee massive rates decline across the board because lenders still have to price loans based on credit risk, margins, and liquidity. But even a modest shift, where average rates maybe move closer to 5.5, could materially impact buyer affordability. So, a quick pricing snapshot. Here's what we're seeing on the pricing side in the Valley. Homes under $400,000 have seen slight declines in price per square foot as affordability ceilings were tested in 2025. The luxury segment, particular properties over $10 million, those continue to climb, with price per square foot increasing at higher market rates than most of the market. Mid-tier ranges stay relatively stable depending on where you're at in the Valley, and that balance is keeping the overall market from major swings in either direction. Local momentum, however, is real. According to the latest Cromford Market Index data that we track, 16 of 18 of their main tracked cities moved further in favor of sellers in December. Gilbert, Phoenix, Glendale, Goodyear all showed particularly strong month-over-month gains in market conditions. So right now, of the 18 areas tracked, 10 sit in a seller's market territory, 6 are in a buyer's market territory, and 2 are balanced. But that shows momentum as we head in the new year. So what does this mean for you? If you're thinking about buying, selling, or investing in 2026, this dynamic early movement, lower rates, renewed activity, and real policy level intervention makes staying informed critical. This market won't be about massive shifts every month. Instead, it's going to be about timing, positioning, and making a smart move when the window opens. If you want to talk through what all this means for your goals this year, let's connect.